Welcome to this version of webinar by India Ratings on Indian nbfcs. Today we have Prakash Agarwal with us discussing key issues and trends which we are seeing on this sector. So without much delay, I would like to hand over the mic to Prakash.
Thanks, Satish. Today we will be discussing some of the themes which we hope to be of interest to you. So some of the points like, in terms of how the growth of NBFCs has come from, how do we see it moving forward, some of the points specifically in terms of how do we see NBFC sector evolving in the next few years, what could be the impact of banks' constraint on capital, how the NBFCs are positioned in terms of liquidity to factor the possible taper, the debate between banks and NBFCs, how is that progressing, and what does it mean for NBFCs, and then finally we'll try to summarize through what the NBFCs rating actions have been for India ratings for FY15. So to start with, this first slide depicts how the NBFC sector, if you see how it has matured over the last few years. So NBFCs, which were small players 10 years back, have really grown up and are now more stronger and comparable to some of the mid-sized banks. Now, the way to read it is that some of these banks also have a strong growth in the last 10 years. But the NBFC's expansion and in terms of equity has been phenomenal. So now some of these NBFCs are comparable or even larger than some of those mid-sized banks for the last 10 years. So that reflects the market confidence which these NBFCs have been able to accrue for themselves. And this capital growth is also has been manifested in terms of the great market share for NBFCs. So what we see that NBFCs have been accruing their market share. So from 2010 to 2015, the NBFC's market share has almost grown by about 35%, and the pace has been gaining pace from last couple of years. After last year and from last 4 or 5 years, we have seen that the pace of growth for in terms of market share for NBFCs has been very robust. So if you try to bifurcate the segments where this growth has come from, if you see by FY11 and before, the infra financials were dominating the NBFC space. And asset financials and other segments were somewhat still emerging. In the last 4 or 5 years, we are seeing that while the infra financial space has somewhat shrunk or has not grown at that pace, the asset finance companies and other wholesale has really expanded much sharply. I must bring a point that in the period between FY11 to FY13 was a period where asset finance companies were growing at a sharp pace, and in the last 2 years, the NBFC growth, a large part of that growth has come from wholesale lending, or if I put that way, diversified lending piece, which has actually driven the growth for NBFCs in the last 2 years. Whereas asset finance growth has somewhat been moderated in FY14, and more importantly in FY15, the growth has been very low, has been far more modest for asset finance companies. The next slide, of course, is a representative down sharply. It's like more like, and if you see the last, seeing that become favor kind of a sector portfolio, which are the SME lending has been the driver. So if you see, of course, the growth has come down in FY15, but the LAP piece continues to expand at a faster rate than the overall piece. Why we think that why we think that there could be a concern in this piece? A couple of reasons. One is that there is a very limited seasoning which is happening in any borrower's piece. You see a large part of portfolio churning within a year. So because of the churn, we are not seeing enough seasoning in any of the borrower's portfolio, in any of the lenders' portfolio, and that could have impact in terms of actual credit cost of the borrowers. mostly a DSA-driven model. A large part of this book is being originated through third parties DSA model, and we have seen that during the stress, generally the DSA-originated portfolio has performed somewhat weaker compared to the portfolio which have been originated directly. And while the LTVs of this segments are in a reasonable range, about 60-65%. We are not very sure, in terms of if that property were to be liquidated, whether that property could be liquidated in a time-bound manner, which could have implications for the credit cost of the lender. So while this could be somewhat, the low LTVs in this segment could be may not be of that much comfort, while it looks like at the time of initiation, if that property were to be required to be liquidated to generate to recover the money, whether the liquidation could be possible at least for a majority part in a time-bound manner. So that is one of the concerns that we have on that portfolio. One strength, of course, one of the strengths which could come in this segment is the securitization piece, the SARFAESI Act, which is likely to be applicable for the NBFCs in some time. That could certainly have some positive impact for this segment, which could ease out the recovery process for this segment. The other piece of growth, as we discussed, has been the real estate lending. Typically, if you see the structure of real estate lending, have been starting with initially few quarters of moratorium, and then principal payment startup. Now, this piece has grown up in the last few years only, and we are not seeing yet a sizable portfolio. So what we are seeing is that still a large part of the lending, the principal payment is yet to start for that piece. So, and given the market conditions where the sluggish market condition of real estate piece, the recovery could actually be could come into pressure if the market doesn't recovers. So while the NBFC is stepped in to finance a part of the bank's portfolio in terms of taking up some of the credit the banks are doing in real estate space, how does that sector opens up? How does that sector plays up? In this subdued market, that has to be yet to be seen for the real estate lending. The next chart shows in terms of how the market share is market share for and how the SME lending has expanded. So if you see this is the chart which shows how the 2-year CAGR growth for the large players, and how they have and how do they place in this quadrant. So the players on the extreme right low are the players who have high share in low growth, and the one which are on the high on the right top is high share, high growth. So we see that some of the players which are into the high share and high growth piece over there, maybe some of the risk, some of the piece which we need to understand in terms of how strong is the credit appraisal standards, and how in terms of stress, how the portfolio will perform if there were to be stress in that portfolio. This chart, we are trying to understand the sustainability piece. So the previous chart was, of course, from the perspective of where the growth has come from. This chart, the understanding is whether the growth of the NBFC is sustainable. So we see there are clearly three market, large credit disseminated in the market. One, of course, is the private sector bank, the new age mid-sized private sector bank. The second piece is the public sector bank, and the third piece is the NBFCs. So they have all their niche where they are operating. So in the new age private sector bank, typically have, while there will be similar sectors of the NBFCs in the retail piece majorly, but they are into somewhat safe, what we call safer segment. So they would be pricing, while the credit costs would be low and more stable, their profitability also is somewhat lower in that sense. Whereas if you see the public sector bank, they are clearly, it seems the data suggests that they have not been able to price their risk. So the credit costs have been far higher, where the profitability has been far more subdued. NBFC is operating in a niche segment, very niche areas where they're operating. In somewhat higher risk category areas. So the credit cost depicts that there is a volatility and somewhat higher credit cost. But I think that gets compensated by somewhat higher buffers in terms of profitability which they generate. So through the cycle, NBFCs would be operating into somewhat risky credit segment, but of course that would be offset by the higher profitability or higher the buffers which they would be generating in their core segment where they are lending to. Now we are trying to move on to in terms of what is the Basel III that primarily for banks. What does it imply? What is the implication for NBFCs of Basel III for Basel III capital requirement for banks? So if you see, Basel III has an onerous capital requirement, puts an onerous capital requirement for banks. And there is a huge, as per the India Ratings estimates, the capital requirement for Basel III could be, overall capital requirement could be on upward of 5 trillion. Of that, almost 2.3 trillion capital requirement is in form of equity. Clearly, mid-sized banks, especially the mid-sized banks, have a huge task in front of them. The kind of valuation they are trading at, that makes raising capital for that from the market difficult. And the government stance, if you see in last few years, have been less benevolent in terms of, at least for the banks which are not really performing well. So we see that there is clearly not enough capital available for mid-sized banks. Now, a part of what we're seeing is that in terms of if the projected GDP growth were to materialize, that would have a sizable demand on credit requirement from the market, and that credit requirement we think would be supported by some part of that credit requirement would be supported by NBFCs. NBFCs, and the reason for that would be, of course we discussed that, but one of the two strengths of NBFCs in terms of their ability to structure loans. I mean, NBFCs in terms of understanding some of those specialized lending, where understanding in terms of cash flows of the borrower and structuring the loans in terms of include with the cash borrower's requirement is important. NBFCs are also at least somewhat better placed than the counterpart in the public sector, at least the mid-sized public sector bank, to lend to the sector profitably. So this is again a similar chart that we discussed previously, that in absence of capital infusion from the government, what is the kind of growth we are seeing for public sector banks. So starting from, as you are seeing, in case of no government capital infusion, the growth could be as low as 6% for the system-wide public sector bank, and gradually moves up depending on what kind of capital that the government provides, of the required capital from the government side. So what we see is that in absence of in case of public sector banks not being able to fulfill the credit requirement of the system, what we see is that NBFCs would be capturing a part of the growth. So in our understanding, in the next 4 years, the credit the market share of NBFCs could move up to closer to 70% from present 30%. So the pace, so the trend which we have seen in the last 4 years would continue, and NBFC would continue to gain market share over the next 4-5 years. At least that's a clear secular trend we are seeing for NBFCs. The average and what we assume, what we see that the credit growth would be in the region of 22% for NBFCs for the next 4-5 years to achieve that kind of market share. And one of the strength for this NBFCs for this kind of capital is that capitalization. To start with, they are very capitalized. They have strong capital to capture the growth which is likely to accrue. and comfortable internal accruals in spite of lower leverage for NBFCs. We see that internal accruals are comfortable and compared with some private sector banks. So the NBFCs are very capitalized to capture the growth. So not capital as likely to be a constraint, which is also supported by the market valuations. So if you see last 4 years, the NBFCs index has performed better than even the private sector bank. By that volatility depending on their performance, but the performance has been stronger than private sector banks of the NBFCs. So what this implies is that the capital is unlikely to be constrained, given that NBFCs are able to price their risk, are able to generate superior returns. So capital is unlikely to be a constraint to unlike the public sector bank, to get that growth or to achieve that great market share for NBFCs. Now the point is how, in terms of what could be the impact of the possible taper, and which looms in some time in future, but which seems more like a reasonable, at some point of time it will come. So what could be the impact? I guess the understanding is, of course, it could have while it's difficult to quantify or predict what could be the implication of that, but one of the understanding is that there could be impact on liquidity of the market. The liquidity could that could have a repercussion on the liquidity which is market liquidity which is available. Now, what we see in that in that sense, NBFCs have in terms of they maintain pretty well matched asset liability tenor. At least the larger and the higher rated NBFCs are pretty well matched asset liability tenor. So in that case, if there were to be extreme tight liquidity institutions, refinancing is unlikely to be likely to be a risk for at least for the larger rated, strongly rated NBFCs. And this we see a clear shift from 2008 when there were somewhat mismatches in the NBFC's book and some of the long and mismatches in terms of tenor of their assets and liabilities, and some of the longish tenor assets were being financed by short tenor liabilities, and some of the NBFCs were caught on the wrong foot when the liquidity tightened during global financial crisis. NBFCs have learned their lessons well, and now they have a far more stronger funding profile, matched asset liability tenor, so which reduces the refinancing concern for NBFCs. While one of the extreme case in terms of tightness of liquidity could be on the balance sheet, but refinancing risk remains largely manageable for most of the NBFCs. We have also tried to understand in terms of the LCR ratios which have come from bank, and if you apply that to the NBFCs, how do they fare? And the way it has been calculated is in terms of this is what the calculations are. Basically, liquid LCR assumptions, which is weighted high quality liquid assets divided by weighted net cash outflows, and the cash outflow is cash outflow minus cash inflows. Given that most of the NBFCs are well placed, even the stressed cash outflows are lower than the stressed cash inflows. So in that case, most of the NBFCs, the liquidity coverage ratios are pretty strong. So even in the extreme tight liquidity scenario, we see that NBFCs are well placed to withstand that pressure. That's about the strength. So I guess our rating estimate that most of the NBFCs have learned their lesson and they can withstand even the tight liquidity scenario, ultra tight liquidity scenario for short tenure. One of the development in the last few quarters have been the establishment of Mudra Bank, which we think could be another strength for the NBFCs, which could act as a lender of last resort for NBFCs, and that could have a structural strengthening on the NBFC's funding structure. This slide tries to depict how does the liquidity scenarios for two separate segments. One, the NBFC which is operating in the retail space, and the other is the wholesale NBFC space. Of course, given that concentrated nature of lending for wholesale space, even couple of delays in payment could have impact on liquidity for wholesale NBFCs. Vis-a-vis retail, where even some few players delay their payment, the impact of liquidity is far more manageable. So from that, it's expected, and we have seen that wholesale NBFCs could have higher impact of any liquidity tightening in the market, both from terms of in terms of delays of the inflows. So what we've seen that most of the NBFCs wholesale who are operating in the wholesale space maintain reasonable liquidity to overcome any tightness which could accrue in the market. Debate between NBFCs and bank. You see, this is what we see that these both are complementary in their operations. So most of the banks have a far more stronger liability profile compared to NBFCs. NBFCs are largely dependent on wholesale funding. So this chart, which compares one mid-sized banks which are smaller, which have just started and which have started few years back, and a smaller franchise, even funding of that bank is far more stronger compared to one more established NBFC, which is far more established franchise funding. So for banks, of course, the funding remains a strength. That the banks. So in that sense, that funding franchise of even a smallish bank which would be far more is likely to be stronger compared to one more established NBFCs. Now, the implication of, and if you see, most of the NBFCs are still largely dependent on banks. So banks continue to fund a large proportion of funding for NBFCs. So they are kind of complementary. So while NBFCs have a niche in terms of lending and growing their market share, funding, we see that they would in the near future at least would largely remain dependent on banks for their funding requirement. So the idea is that NBFCs would necessarily the banks act as a kind of a complementary for NBFCs, and the liability profile, and NBFCs could actually benefit from the strength of liability profile of the banks and use that as for credit distribution in the market. Having said that, in last few quarters, what we've seen is that the market rates have come off sharply. There is a wide gap between banks' base rate and the rate at which the higher rated NBFCs can raise funding from the market. And the impact of that is that we are seeing some shift of funding from banks towards market borrowings. That is, having said that, while there could be while there is a possibility of a proportionate some shift in terms of funding of NBFCs towards market, but we still believe that a large part of NBFC funding would continue to accrue from the banks, and the banks would continue to remain a major source of funding for NBFCs going forward as well. Some of the factors favoring NBFCs, if you see, NBFCs have emerged as a viable business model in itself. A few years back, when the discussion was more in terms of NBFCs operating more on a arbitrage between banks and NBFCs, now more and more NBFCs are playing on the previous model strength rather than arbitrage. Already we are seeing that there is some kind of convergence. The NBFCs are moving towards 90-day DPD recognition on NPS as well as on capital requirements is more in line with banks. And in terms of banks, we are seeing that the SLR ratio is being reduced, and there has been discussion that on the SLR ratio is being reduced further going forward. So the play for the operations in the market will be more in terms of business strength rather than the play arbitrage side. In terms of regulators, what we see that regulators have become far more appreciative of the role which the NBFC plays, the uncertainty in terms of the role of NBFCs it seems to have reduced considerably. In terms of that is one of the strength which has emerged for NBFCs. In terms of government thinking, the government is warming towards multiple sources of credit dissemination rather than only the PSBs being or the banks being the disbursing credit, and that is also reflected in terms of Buddha Bank which has been set up, which is likely to be support funding NBFCs, RRBs, MFIs for further dissemination of credit, which has been funded with 20,000 crore, vis-a-vis about 8,000 odd crores of capital, which has been allocated for the banks. Two features. One is the applicability of SARFAESI, and Buddha Bank are likely to strengthen the structure of NBFCs. SARFAESI, at least in terms of wholesale lending, as we discussed some time back, would ease recoverability in terms of default, which will reduce the time frame by which the lending the delinquent accounts could be solved, and that could have a far more stronger impact. That would have a far more stronger impact in terms of losses in default, vis-a-vis where the NBFCs don't have access to SARFAESI. And Buddha Bank, as we discussed, that could act as a lender of last resort for NBFCs. And the last point, but not the least, is in terms of niche for NBFCs. We have seen that certain segments, NBFCs are far more well-placed, like asset finance, commercial retail lending, some of the small SME lending. NBFCs clearly have an edge in terms of understanding the credit requirement, structuring the credit requirement, capturing the cash flows, access to last mile touch point to the borrower. So some of the segments where NBFCs clearly have niche, and we think that going forward, NBFCs would more and more grow in that segment for the NBFCs. Moving on to rating actions for FY15. So India ratings have been somewhat positive on NBFCs in the last couple of years, and that the factors that we discussed in terms of their strength, in terms of the pricing their loans, in terms of capital strength, strengthened structure in terms of liquidity funding, that has certainly strengthened the overall NBFC space, and India ratings have been somewhat positive on the NBFC space over the last couple of years. This chart shows some of the NBFCs which we rate, which are driven by performance, their standalone performance. And this is chart which some select NBFCs which India rating rates, and the ratings of which is driven more by the support factors from the parents. These are some of the rating actions which India ratings have taken in 14 and 15, and our views on some of those NBFCs' structural strength is reflected on the rating actions that India ratings has taken over the last 2 years. And the below two pie chart shows how the NBFCs are spread over various rating categories. On the left hand side are the categories of the standalone performance-driven ratings. On the right hand side, pie chart shows the support-driven rating, how that is panned out in the India ratings portfolio of rated issuers. So with that, we come to end to our presentation. I would like Satish to hand over.
Well, thanks, Prakash. At this point of time, we will take questions from you. There are three ways to reach us for asking questions. One is to type in your questions in the webinar control panel. You can type in your questions and we'll take from there. The second is to email us at investor.services@indiaratings.co.in. That's investor.services@indiaratings.co.in. Or you can also reach us by tweeting your questions @IndiaRatings. That is @IndiaRatings. Well, I'd like to take the first question from Manish. who's based out of Singapore. Well, Prakash, this question is, what are your views on RBI's recent, regulatory actions on NBFC? Basically, they have subdued most of their, or they've clarified their stance on the regulations. So, does that mean that they are now ready to be converted to banks?
I think RBI have been more appreciative of the NBFC sector over the last few years, and we've seen that some of the regulatory uncertainty which was there on the regulatory aspect in terms of how the review has diminished considerably. Having said that, they also want to have somewhat strengthened the structure as well. So in terms of move to 90 DPD and capitalization of 10%, which is more in line of banking capital. So the idea is to have to operate multiple sources of multiple channels of lending, and but in terms of more in terms of business strength rather than regulatory any arbitrage in that sense. In terms of whether it's a step towards banking, could be, but we will also see, as we also presented in our presentation, that one of the challenges for the NBFCs has been the funding. They are mostly wholesale funded entities, and still a large part of the space is dependent on sizably dependent on banking for their funds. I think that the way it is operating is that making the regulations more of a similar on a similar platform or similar level playing ground for both the banks and NBFCs in terms of regulation, and then from there on developing the various both the segments as they grow.
The next question is on: are you seeing an emergence of new NBFC category focused on SME financing to small businesses post the setup of Mudra Bank, which is beyond microfinance and lower than the segment targeted by banks?
Well, we are seeing select classes of emergence of select classes of NBFCs which are emerging into financing of SMEs, SME focused lending. And that, of course, as we discussed some from both sides, that SME collateral-based lending have been the growth driver for some of the NBFCs in FY15. So clearly, yes, that segment has come as an attractive piece for SME lending over the last few years. Also driven by attractive yields in that segment, lower credit cost for that segment. So yeah, that is it. However, whether Mudra Bank per se in itself would expedite or hasten the pace of that NBFCs, we don't think so at the moment, at least. Mudra Bank, I think at the moment is more as a supporter of liquidity for NBFC, which could turn out to be more of a structural strength. But NBFCs, more NBFCs coming up, primarily lending for lending to SMEs because of Mudra Bank coming in. We would at the moment doesn't seems to be doesn't seems to be the driving force for the NBFCs to set up for funding SME. So yeah, but this space clearly is very attractive, particularly because mid-sized public sector banks would be vacating this space, and piece of NBFCs would probably, at least in some of the segments like textiles, construction, real estate piece, NBFCs would be probably in a better place to capture that market share.
Because the next question is also related to actions by RBI. Do you feel that RBI wants to cap the size of NBFCs so that it does not become too big to fail?
See, I don't think that RBI is purposely going ahead and trying to cap the size of NBFCs or restricting the size of the NBFC. That certainly we have not seen that in terms of actions. However, the structure of NBFC model itself, with large dependence on wholesale funding, at some point of time, the structure of NBFCs, the model of funding for NBFCs could become somewhat challenging for NBFCs to grow beyond a certain size. So, in that sense, one of the reasons why some of the NBFCs are attracted towards the new banking license which were being accorded was primarily because of the attractiveness of the funding piece. So after some point of time, the funding certainly becomes kind of a challenging for NBFCs. At a reasonable rate, raising fund from the market could become challenge. So in that sense, yes, as the NBFCs become larger and grows in size, NBFCs start looking at various sources of funding which could support their size as well. So yeah, that could be the case. But RBI purposefully would not like to restrain the size of, or has not stated as such that restraining the size of NBFCs will be one of their objectives.
The next question is, don't you feel that loans from banks to NBFC is already over 5% of loans, which will lead to growth slowdown in NBFCs due to funding?
So we saw that some of the banks caps on the individual sector has some of the lendings of the banks towards NBFC has been touching the caps, internal caps which the bank has. So some of the banks lending to NBFCs, and we saw that in FY15 it said that the incremental loan book to NBFCs of the banks has come down. That has come down. But what we are saying is that given the way the NBFCs operate, at the moment, of course, there is a large dependence of NBFCs on the bank, but we would see gradual shifting of the NBFCs funding as well. So while the banks would continue to remain a large portion, some of the higher rated strong NBFCs would probably migrate to the market funding, would start raising funding from the market funding would step in and feel a part of funding requirement of funding requirement for NBFCs. So if you see that in terms of NBFCs, we are seeing that more and more NBFCs have been raising the long-term issuances from the market for their funding requirement. So I think, so there could be a few banks where where incremental funding to NBFCs could become tougher, but still we see that there is enough gap gap in some of those larger banks for lending, and market funding, of course, could be another area where the NBFCs could raise funding from.
Prakash, the next question is, as per you, will NBFC gain substantial market share by FY19? In which sector you think they will gain market share? Will it be SME, MSME sector?
I think NBFC will continue to gain market share where they are niche. So, starting from asset finance space, where NBFC certainly have niche. Used vehicle space is another area where we think that SME would expand faster. SME lending, of course, is another area where the growth would come from, especially in the mid-size corporates, smallish corporate. NBFC's growth will be faster. So yes, these are some of the segments where we think that the SME space growth would be stronger, and they would be gaining market share vis-a-vis banks.
Prakash, the next question is on housing finance space. Do you think the housing finance space is getting crowded? We are seeing a lot of NBFCs getting into housing finance, especially affordable housing, in the last couple of years. They all say that the space has a lot of potential for growth, but with economy yet in a downturn, Is the sector getting overcrowded?
Well, this presentation was more from pure NBFCs and not housing finance companies. But let me try to answer this as well. So yeah, a part of the reason for shift of housing finance companies towards affordable housing, I mean that we're saying that on the higher ticket lending side, there's been huge competition getting in. The yields have come down really sharply in that segment. So I think a part of the growth which has come from into the lower tickets is also in search of yields for NBFCs. Sorry. Yes, there is a lot of potential for that segment. Of course, there is a huge potential for the low ticket affordable housing segment. Having said that, one also needs to understand that this segment is also in a high OPEX cost segment. Moreover, it's very widely diversified, widely diverse customer client location. So tapping that segment and building a book on that could take some years for housing finance companies to grow. And that's in that segment to assess the credit worthiness of the borrower would require special skill sets for housing finance companies. So and given that this space has only recently come up, how does the credit behavior of the borrower performs, and whether the NBFCs, housing finance companies, are strong enough to assess the credit worthiness of the borrower, whether the credit costs in this segment are closer to what we have seen in the overall housing finance segment. I think that piece is still to be yet established for that segment. So to summarize, that there is a huge scope for that segment, but we are also seeing a lot of competition getting into that segment. That segment is also marked by somewhat informal credit processes, systems, and so that segment is still being developed, and so how profitable and what could be the and profitability of that segment, factoring in the credit cost and the OPEX, I think that will be established in the next few years on that segment.
The next question is on the NBFC capitalization compared to PSUs. What is the impact of provisioning norms change on NBFC's capitalization? I guess this is referring to one of the charts in your presentation.
Well, provisioning norm will impact the profitability. I don't think the provisioning norms are impacting the capitalization at the moment. Of course, as per the RBI requirement, the NBFCs have to move to 10% Tier 1 capital by FY17. That, of course, is likely to be a challenge because most of the NBFCs are operating at a sizable buffer beyond 10% at the moment itself. So 10% capitalization per se would not be a challenge, and this provisioning norm could have some impact on the reported profitability of NBFCs, and that could have impact on internal accruals, but capitalization to start with would not be much impacted because of shift from current 180 day, which is current availability of 50 day to 90 day DPDs in next 2 years.
At this point of time, we are, completely out of time, but we'll take a last question. Prakash, this is, how are the delinquency trends emerging amongst different classes of retail assets where NBFCs traditionally dominate, such as LAP, home loans, auto financing, and unsecured SME personal loans? Do you see any additional funding requirement there?
So if you see, of course, as you said, the NBFC operating in this segment, they also operate somewhat in terms of somewhat moderate credit borrowers, if you put it that way. And that, of course, has implications. The credit costs are likely to be more cyclical vis-a-vis more established, stronger banks, when I say tertiary banks. So yeah, we've seen in the last couple of years, at least in the asset finance space, the credit cost has risen, both the delinquencies and credit cost has gone up. But we think that FY 16, there will be some kind of recovery in the asset finance space. LAP is still, is still to see full cycle. That segment is still growing. And as we enumerated in our presentation, part of that is because we are not seeing enough seasoning of LAP book in any one borrowers. We are not seeing enough seasoning in the lender's book. There is a sharp churn which is happening in the book. If there will be tightness and this churn stop, how will that portfolio perform? That the credit cost would sharply go up in that segment, but at the moment the credit costs are in the LAP are benign, though there will be marginal uptick in the credit cost, but still it is far benign. Similar is the case with which is into auto financing space. What we are seeing is that the credit cost in the auto financing space also has gone up somewhat, but still it's very covered by the profitability. In terms of home loans, that is one space which has stand cyclical downturns. The credit cost still remains below 50 basis point across HFC lenders, and home loan has stand tall in this downturn. So that is one segment where the credit cost has not picked up in the recent downturns.
Well, thank you, Prakash. With this, we come to the end of this webinar. Your feedback is important. I request you to please send your feedback to investor.services@indiaratings.co.in. We'll be also hosting a recording of this webinar soon. Please watch out the space at www.indiaratings.co.in. Thank you. Have a nice day.